Tiger 21 is a peer-to-peer learning network for high net worth individuals, and their latest poll shows its members holding cash. The cash holdings of those members who have it has gone from 12 to 19% in the latest quarter. Michael Sonnenfeld is the founder of Tiger 21. Michael, welcome. Good to have you with us. How many members does Tiger 21 have, and what is their sort of geographic and net worth distribution? Tell me who I'm talking about here.
Yep. So we just passed 800 members recently, all-time high. We've been growing through the pandemic. We operate in 4 countries, the U.S., Canada, England, and Switzerland, and more on the way. And the total members' assets are about $80 billion. All of our members on average are about 1 in 10,000 by accomplishment, if you look simply at their financial achievements.
And so they would run I don't mean to bog down on this, but I'm reminded of the famous Woody Allen line, I never want to be a member of a club that would have me as a member. So is there a low point? You have to have 100 million to get in, or what is it?
Our members generally have created wealth in the $10 million to $1 billion range. But Tyler, for you, you're welcome anytime. Most of our members built businesses over 30 years. And these are people who started, these are first generation wealth creators. Our distinction, the part of the market that we own, is first generation wealth creators, entrepreneurs, partners in businesses, CEOs who come together in a monthly meeting. We have 60 different groups around the globe that meet now virtually. They used to meet in person. We've continued unabated and continued growing through the pandemic because of this confidential setting of peer-to-peer learning that we provide.
So let's get to the real payoff here, and that is the fact that the cash holdings of these members have risen really by 50%, from 12% to 19% in the most recent quarter. What have they sold, and why are they making this move? Obviously, defensive reasons would explain it, I assume. Yeah.
So, sure. This is an extraordinary change. We've been tracking this number for more than a decade. Until this month, it never was above 13%, never below 11%. This is like a 4 or 5 or 6 sigma event, nothing ever close to it. When you add to that gold holdings, another 2 or 3%. Mostly because our members have about 70% of their assets in public equity, private equity, and real estate. Real estate's the largest, private equity next, public equity at about 21 or 22%. That's where it's come from, although in trying to build resources prudently, obviously they started with the public equities because those are the most liquid. But over time, as real estate funds pay off or they have liquidity, they will not reinvest in those areas if they want to keep cash balances high. And the answer is, on the one hand, yes, it is very defensive. Members are deeply concerned about the gap between Wall Street and Main Street. People are hurting out on Main Street. The markets don't quite show that. So they want to be prepared. But also as entrepreneurs, they want to pounce on an opportunity when it happens. And in markets like this, particularly on the private side, but certainly in the public side, you can find amazing opportunities if you can move quickly, have the fortitude and the knowledge. And that's what really characterizes our members across the board.
Michael, I'd love to know, as you just said, that your members are, trying to prepare. And, for people at home who may not have $10 million or who may not have earned $10 million, but they also want to be prepared and they also want to act defensively. Do you feel like people at home might glean some lessons from this as well?
Sure. First of all, it doesn't matter how many zeros you have on your balance sheet. You want to be conservatively positioned. And no matter how much you have to look at your living expenses. In the case of wealthy Americans, on average, they live on about 2% of their assets. So if you have 12% in cash, that's about 6 years. If you're in a different situation, you have to look at it. But the most important factor is you don't want to be put in a position to have to liquidate your best assets just at the wrong time. So by building cash reserves, you can avoid being forced to liquidate your best positions. And moreover, with cash, you can buy assets at a discount wherever they are. You might be an expert in the public markets or in the private markets, but having cash is the asymmetry of protection on the downside, but waiting for opportunities on the upside.
Michael, we have to leave it there. Thank you, and thank you for your very gracious offer of membership. I can't tell you how tickled I am. Michael Sonnenfeld, thanks.